let's talk quickly about what the three components of this synthetic are. And I'm going to go back and share my screen if that's okay, Mark. Were you
Yeah,
done?
go for it. And actually, I will say one place that this is helpful to know and to understand why these relationships should exist is that if, without thinking about anything here, assuming McDonald's is trading 233.35 and you're looking at the 232 strike. So in theory, that call should be in the money. Stock is higher than the strike.
Right.
Naively, that call should be in the money. But the call is trading $1.62 in the market and the put is trading $2.01.
Mm-hmm. Right.
So
exactly
you're saying, hey, this strike is under the current stock price and my put is worth more than my call. Why? Like that doesn't intuitively make sense. And so it's a good kind of gut check to say, what could be going on here? You know, in this case, it's a dividend, and that's clearly why that might be happening. But another reason that might be happening, and this is definitely worth knowing if you're considering speculating in some of these names that we call hard to borrow, a high negative interest rate will have the same effect.
Right.
So if the stock is in high demand to be borrowed, and a lot of professional traders are gobbling up the stock to hedge their positions or bet on shorts on the company. If you see a lot of short interest, a lot of borrowed stock, or a lot of people buying puts that is raising the cost of borrowing stock, that means there are a lot of people speculating on the cost on that stock going down. So if you start seeing your puts over calls, that might be an indication to say, hey, there's a lot of short interest in this market. There's a high negative interest rate. And it's really good sort of market context to know where the price of borrowing that stock might be.
Exactly right. Exactly right. So we have another question. What applications to retail trading? Like I said before, you know, you're not going to sit here and try to do this spread, okay? But it's important to understand the relationships because then you get a bigger grasp. And Mark and I are going to do a series of these kind of educational webinars going forward, maybe 6 in a row. This is a little bit more advanced topic. We're going to float around a little bit, but I learned understanding the relationship of calls to puts by starting here, believe it or not, back when I first learned this stuff. Okay. And on my screen, I have this synthetic on again, long call, short put, no stock involved. Okay. So let's just take off the short put and add stock. Okay. So if I add stock to a call, it's got to be, I'm long a call, I'm going to be short a stock, right? So I have the 1-to-1 ratio. That synthetic is called a long put, right? Long a call, short 100 shares, the corresponding number of shares is called a long put. What do you do to hedge a long put? You sell a put. Which put would you sell? Well, the one on the 232.5, if you did it, now we're back into that synthetic again, right? Now let's take out the long call part of this. Short stock, short put is short a call. Okay. How do you hedge a short call? That's synthetic. You have to buy that call. Back to the same thing. So these three combinations will always make variations of themselves, and the money has to be equivalent. So if you are a retail trader, you should do an exercise and see if this is true. I will guarantee you it will come close to pennies that if you add up the values, long stock, long put, okay, that's a long call. It's going to be darn close to the call price. Okay. And we're going to talk about it in next week's episode, how to do the synthetics, what the math is to add these things up to come up with these values. Same deal. We're just taking little segments of that original equation and relating it.
No, I think the underlying theme here is that the simple relationships between the calls and the puts can illuminate a lot of really interesting pricing opportunities and context about what's going into the overall pricing model.
Right. Thanks for coming. Great episode. And thanks viewers for the questions. We appreciate it. And we will talk next week, 11 a.m. Central Time on Market Minutes.